Hello friends, my name is Kumar and I am a certified risk management professional from Institute of Risk Management London. I have a total working experience of 25 years in the life insurance sector that spans between the work in the actuarial firm and risk management. Risk management is kind of my passion, and as a result of that we have formed Risk Management Association of India, where I am a joint secretary. So today's session is basically inspired by talking to the people on the fundamentals of the risk management. In this session we are going to cover what is risk, because it is very important that to first know what is risk. The second that we are going to cover is what is risk management, because risk in itself has got no meaning unless and until it is managed. Then we shall move to the enterprise risk management and talk about what is the difference between the silo risk management and enterprise risk management. And then we shall talk about what are the processes of the risk management. The first question that we ask is what is risk? Because I have often seen that people do not have the idea about what is risk, and if you ask a question that what is risk, people will say, oh, there is no risk. And if you can ask again, what is risk, and then people say, I don't think there is any risk. And if you further probe that what is risk, then people will say that I don't think this is going to happen. And if you go further, it thinks that it has never happened, why it will happen today. So that's generally the practical experience that I've got while talking to people about what is risk. So it's very important that to understand what is risk. Generally it is thought that risk is a hindrance, it's a showstopper. People confuse between risk and the problem, because problem is something which is today, risk is futuristic, and there is a whole set of confusion between audit and the risk. So the key question is that what is risk? Let us look at these four pictures, and in the first picture we see that the tire of a car is flat. The person is going to office, and the risk is that if his or her tire get flat, the person may not be able to reach the office in time. In the another picture you see that person running after the bus, and I expect this is the morning time and the person is approaching for an office. It seems that he has got late on the bus stop and he's running after the bus. What is the risk? The risk is that he will reach office late, or he has to wait for the next bus. Next bus may not arrive, so on and so forth. In the third picture you see that there is a hole in the pocket. The person has taken out his old jeans, and when he's putting his money in the back pocket, he has found that there is a hole. And what is the risk? The risk is that when you go out and is going to pay for something, you may find that there is no money in his pocket. And in the fourth picture, the person is has again taken his pant, which is maybe perhaps few years old, and his tummy has grown, and as a result of that it's not going to fit his pant. And what is the risk? The risk is that he may not able to go out, and therefore he may not able to do something which he is intending to do. So you will see that there are certain things common in all the four pictures, and these things are that you will notice that there is an objective. There is an objective in the above two pictures. The person is to reach office, and in the below two pictures the person is to go out. So in each of the four cases there is an objective. The second is that all the things are futuristic. And one more thing which is there that creates an uncertainty. So uncertainty, future, and objective are basically three key elements in the definition of risk that we shall see in the next slide. Now again, our same question: what is risk? Why I am asking, again and again, what is risk? Is because if this is clear, then I think a lot of risk management is clear, right? So in a risk, there are only two things which is required in a risk. One is the objective, and second is the future. And because it is a future, the future creates uncertainty. Therefore, you will see that in the first point, effect of future uncertainties on the objective, right? In all the four examples that we have seen in the previous slide, it's talking about the future and the uncertainty. Uncertainty is that the tire could be flat, you may miss the bus, your pocket may have a hole, your pant may not fit, right? And this is because about the futuristic event, and the objective is that in each of the cases you have to attain certain things. So uncertainty, basically in the case of uncertainty, in a risk management terms, it is about the adverse outcome, but the uncertainty also gives you, because in future good or bad both can happen, therefore it also gives you the opportunity. And what is objective? Objective is basically a goal that you have set, or it is in a personal term or in a business terms, where what one want to achieve. And how it is done is using the probability and impact that I'm not going to speak here. Before I proceed to the risk management, I would again go back to the question of risk. So we have seen that when there is a risk when there is an objective and there is a feature. Now next question is that when there is no risk, when you will say that there is no risk, it's very simple to answer. There is no risk only under two circumstances. One is when there is no objective, and second, when there is no future. So one may ask a question that when there is no future, how it is possible the future will happen? The question is that future from an individual perspective, it can be the person's last breath, and just before the last breath if there's an objective, right? And because in the next breath the person is going to die, there's no future, and therefore there's no risk. And if a person has got no objective, then there is no risk. The example that can be taken is that if you are going for a walk in the morning, if you see your car has a flat tire, is there any risk? The answer is no, because you're going for a walk and the flat tire does not impact your objective. But the same situation when you're going to an office and you come down to your car and see that there is a flat tire, and you find that, oh yes, this is risk because it is going to impact your objective. So objective has a great role in the management of risk or in the understanding of the risk. So this definition, because that helps in managing the risk. Now coming to the question of risk management, right? The idea about the risk management is that we can take advanced action so that what adverse is going to happen, we can either reduce the impact or avoid the event, right? That's what is about the risk management. That's how we are going to manage the risk. Now what is risk management? Risk management, that you have to take an advanced action so that you can address the adverse impact For example, when you're going out, going to an office, and whether you anticipate or not, you always keep a spare tire, right? And when the tire get flat, you basically change it. Similarly, when you're going to office and you arrive early at a bus stop so that you can board a bus, and if in the same circumstances when you've got your hole in a pocket, so before going that you check your pocket and see that if there is a hole, you basically repair that. And in order to have the big tummy so that your pant is not fitting, what do? You do exercise. So for all the above cases where we saw this risk, to manage those situations we are taking advanced action. Now one thing is that what if those advanced actions are not taken? It is generally called the crisis management, because in that case the event will occur. Say for example, if you're going out and you do not have a spare tire, then and there's a flat tire, so what will happen? It's really going to create a crisis. And in that crisis, what are you going to do? You're going to basically invest more money. Either you will hire another car, you will bring the another tire. So the crisis management is always more expensive than risk management, and crisis management is generally damage the reputation. This is the great thing now that it happens with the institutions. Yeah, so risk management is always preferred over the crisis management. What is the definition of risk management? And I think this is the most beautiful definition I've ever seen, which completes everything within the definition. It says that risk management is to help organization to understand and manage their risks. So the first thing that is coming is that understanding the risk and the opportunities both, and thereby increasing the likelihood. So if you are managing, if you're identifying your risk early, then there's more chances that you're going to achieve the objective, and by doing that you are going to reduce the uncertainty. So this is the most beautiful definition of the risk management, and it is complete definition in terms of defining everything in the risk and the risk management. Now we come to enterprise risk management. And what is enterprise risk management? And because risk management have been into the existence for perhaps hundreds of years, and I am from the life insurance industry, and if I recall, things like underwriting, asset liability management, experience analysis have been into existence for maybe hundreds of years. Or even in the banking sector, there have been credit risk, there have been market risk. So risk management have been in there. So what is this enterprise risk management, and what is the difference between risk management and enterprise risk management? The question is that when we are talking of risk management, and it has been done historically, but you will find that in those risk managements only few departments used to get involved, and it was not that across the enterprise risk management was applied. So yes, few departments were doing underwriting, few departments were doing asset liability management, but what about in the entirety wise, into the entire organization wide? Because there are many things into the risk management which happens across the company, which silo risk management does not cover. So in the enterprise risk management, the risk management is across the organization, and it generally starts from the top, which is at the board level, and goes to the last employee. Enterprise risk management is a risk management that is performed across the organization. It generally starts at the top of the hierarchy, where the ownership of the risk rests with the board, and it goes to the last employee, so that everybody into the system has got a job to do towards the risk management. And while doing the enterprise risk management, the risk management is to be integrated into the daily work life, and it should be part of the integral part of the culture, because if that is not there, then the enterprise risk management cannot be properly implemented. And so This is a way, that the risk management is properly implemented, and it can be thought of like in a body we have got, the blood vessels, right, and the blood flows through it. So the flowing of the blood is like the enterprise risk management, and the vessels are like, the every employee that is working in the organization. So it all starts from the mind, from the head, and goes to the, the toes, and it all need to be integrated across. And as you see in case of a body, that if there is any blockage, there is a the body breaks down. The similarly true with the enterprise risk management, that if there are broken linkages in the enterprise risk management process, you will often find that some adverse events happen, or the body is not functioning properly. You will find that the organizations are not doing well, or risks are erupting, right? So it's very important to implement enterprise risk management across the organization. As stated in the previous slide, that the board has the responsibility of owning the all the policies towards enterprise risk management. Looking back to the economic crisis, and when it was researched that why 2008 economic crisis happened, most of the fingers were pointed towards the board, and reams of paper have been written on the subject. And some of the questions that were asked post the analysis, that what was the composition of the board. Even the board did not have a person with a proper banking background. It was identified that the people sitting in the board are overage, and it was also referred as retirement home. People there were not having relevant experiences. In some of the companies, the meetings, the risk management committee meetings were infrequent, and the remuneration structure of the board members were not linked to the performance of the company. So it has been identified that board plays a very key role in the success of the company. So and without the involvement of board, it is not possible to properly implement. Then from the board it goes to CEO, and then to the CRO, Chief Risk Officer, and the CRO has got the responsibility of implementation of all the risk policies that is owned by the board. And once these things are there, there's need to have a proper governance structure, so that how does risks will be identified, how the risks will be measured, it will be monitored, at what frequency the risks will be reported to the risk management committees. So the next important aspects in the enterprise risk management is the governance structure that we shall see in the next slide. It is important to have a governance structure, that how risk management will run across the company. So there's need to have a different committees like investment committee, audit committee, remuneration committee, risk management committee. At what frequencies those committees are going to meet, who is going to chair those committees, what are going to be the terms and terms of references of those committees, and what will the reporting structure of those committees towards audit committee and the board, right? So having a proper governance structure, what should be the policies and the frameworks. So a proper governance structure is one of the key ingredient for the proper implementation of enterprise risk management. The role of the hierarchy is very important in the implementation of risk management. All the risk responsibilities from the board comes to the CEO, who is overall responsible for the risk management. Then it is passed to the chief risk officer, who has got the role of implementation of all the policies approved by the board. He is basically a custodian of all those policies approved by the board. Then the responsibilities of the different risks passed on to the head of the functions, and then subsequently to the each employees. And that's why the integration of all the employees across the company is important in the management of enterprise risk management. As we have seen, the difference between silo risk management and enterprise risk management is that in the ERM, the responsibility of risk management is across the company. Now the question is that who is the owner of the risk, right? And why that person is the owner of the risk? It goes very simply. The question is that who owns the objectives of the company? When the business plan is made, who is to deliver the business plan? So basically it is the CEO who is to deliver the business plan, and it goes from the sales number, and then sales number, then it's marketing, and it's supported by all the functions. So to deliver the business plan and to get the new business, every function is supporting it. Therefore, every function has got an objective to perform towards the achievement of the objective, which is the business plan. And because those are the people who is to deliver, because they have got objectives. Because they have got objectives, it is they who have to identify what are the risks. It is not the job of the chief risk officer to identify the risk, because the ownership of chief risk officer is not the objectives that that the sales number is to be achieved, the marketing plan that is to be executed, the number of people is to be recruited. It is the HR who is to perform the duty of recruitment. It is the marketing who is to do the job of the marketing of the new products. So it's their responsibility. So it is the responsibility of those functions to have objective, and they have to identify the risk. And in this is called the 3-line of defense model. So in the first line, it is all the functions who perform the duties, that they are the owners of the risk, and it is their job to identify and manage the risk. The risk team, which is risk management team within the company headed by chief risk officer, is basically a second line of defense, and their job is not to identify the risk but to oversee that the job performed by the first line is proper or not. Their job is to review and challenge that, see that provide an oversight, and if there is anything missed out by the first line, the risk team is to do their job. The appraisal of the risk team is based on the fact that if they have not identified and if they have not raised enough challenge to the first line, then their performance is going to be rated down. So risk team is measured on how well they have raised the challenges to the first line. And the third line is an audit team, which whose job is to basically provide independent assurance to the board about the risk and the controls which is within the company. Now we shall be looking at risk management process. That is how the risk management process will be performed. And in the past, in the previous slides, we have seen that around that, what the risk management is and the three line of defense model. Now we shall see what is the process of risk management identification and measurement. Under the risk management process, there are basically 5 steps. The first step is identification of risk, because if risk is not identified, then nothing can happen. The second is measurement of risk, that is, the risk need to be quantified. The third is then after the quantification, the risk need to be managed, and also to basically going forward, the risk need to be monitored, and then finally risk need to be reported, and it need to be reported to the different governance structure that we have shared in the previous slide. So there are different ways of identification of risk, because this is the key step. And as I said in the very beginning, that when we ask the question that what is the risk, and people say there's no risk, so the question is, if there's no risk, then the next steps will not trigger. So the first fundamental question is, what is risk? So the ways of looking at identifying the risks within the company is doing the brainstorming, asking the what if questions. What if this goes wrong? What if this goes wrong? And one of the differences between working in the risk management team and working another first line is that, which I have found, that in the risk management team you should have a thinking mind in terms of what if. So what if is one of the very important ways of identifying risk. The other ways of one can have a workshop where the people from the different team are collected together and having a discussion over the different risk aspects. This is a way of going through the survey. If it is not possible to bring all the people together into one room, then the survey is another way through which risk can be identified. SWOT analysis is also one of the ways through which strengths, weaknesses, opportunities and threats can be identified, and see that what wrong can happen. Stress and scenario testing is one of the ways which is quite widely used these days. Is basically stressing the assumptions and looking at how bad it goes. Through that also risk is identified. Next comes to, because if we have identified say hundreds of risks, all the risks are not equally important. So it is important to see that which risks are important, and to see that there are two things in the risk, because it's futuristic. So what will happen is the probability, the likelihood, and what will the impact. So these two things are important in the assessment of risk quantification, risk measurement. But all the risks may not be possible to measure, because some of the risks are qualitative in nature. So it depends that those who are qualitative in nature, like operational risks, like their qualitative techniques are used, such as low, medium, high for probability and the impact, while for the quantitative one, statistical tools are used. Once it is measured that which risks are important, then they may be arranged in order, and based on the resources of the company, the management plan is to be created. That what if, because these are all futuristic things. So what if those events happen, just say top 10 risks for the company based on the quantification, and then that is called, the next step is risk management or risk mitigation. In this, there are this can be done through either transferring the risk, avoiding the risk, accepting the risk. or managing the risks. So there are certain medicines within the risk management technique which is applied uh, to manage the risk. For example, in the insurance companies, mortality risk, which is the risk of more people dying than expected. In that case, insurance companies purchase reinsurance. In a banking domain, um, interest rate risk, in that case, because of the fluctuation of interest rate or currency, the companies purchase derivative contracts, so they transfer the risk to the another party by paying a small premium. The other ways are, you can avoid the risk, because it means that you do not have a risk appetite, and you can say that you're not going to accept the risk. Other is, you can accept the risk. It means that you are ready to pay if things goes wrong. So generally companies accept the risks due to certain circumstances, and the other is, avoid the risk we have already discussed. So the next step is the monitoring of the risk. In the monitoring exercise, we need to see that the activity that has taken place in the process of the risk identification and risk management, that need to be monitored on a regular basis, and this entire thing is to be reported to the risk management committee and the board. Now we have talked about the risk management, enterprise risk management. Now the question is that what are the applications of risk management? As we have talked that risk management have been in existence for hundreds of years in the banking and insurance sector, but the enterprise risk management is picking it up over last 10 years, and especially after the few crises happening, the risk management is picking up. Also, another reason of the risk management picking up is because the risk-based capital is also picking up in the banking sector. There is a Basel 1, Basel 2, Basel 3, and in the insurance sector, the Solvency 2 or risk-based capital is there. And so, what does this mean? This means that the capital that the company is keeping aside is based on the risk that the company has got. So the equation is very simple, that higher the risk the company is having, the higher the capital that the shareholder has to keep it aside. And the capital is the money which the shareholder has to keep aside. Is basically that's the cost of the capital that they have to imply. So as a result of that, the shareholders would like to have as low as capital as possible, and therefore the enterprise risk management plays a very significant role in the optimization of the capital and the profit as well. So in the Indian scene, Reserve Bank of India, they are already into the Basel II regime, and they are implementing Basel II and Basel III across the Indian industry, and they are already into the enterprise risk management. And so that's a one area where there is an application of risk management. In the insurance sector, the regulator, the IRDA, has mandated the chief risk officer position in all the insurance companies, and they're also slated to have risk-based capital sometimes in the future. So as I see that the application of risk management into the insurance sector is going to increase many folds. Apart from that, in the other areas as well, for example, the SEBI has a rule that the top 100 listed companies should have risk management. There is a company law also which states that the risk management assessment by the board. So as we see today across the Indian spectrum, the application is increasing, though it is not as high as in the developed market, but slowly it is picking it up, and we see that the risk management is going to have great application into the future. In this slide, I'm going to talk about my book, which I have written on risk management in current scenario. This book basically is a collection of all my articles that I have written into the past. The idea was to share all my work with the people in a one go, so that they can read the articles. So the next slide is going to cover the different topics. The book has 8 sections in all. The first section is talking about the basics of the risk management. The second topic talks about the enterprise risk management. After that, risk culture is a third section, which is one of my favorite topics. You will get to know the financial risk management, and in this you will have asset liability management, liquidity risk management. Then there is a section on strategic risk management. One section, small section, is on the operational risk management. And as I told you towards the end of my slide, that risk-based capital is picking it up across the globe. So there are lots of chapters on the risk-based capital, and then the last section is on the application of risk management. So this is what is in my book, and you can purchase the book as given in the next slide. If you want to purchase the book can be purchased either through the Amazon. It can be purchased online either through the Amazon or through Sashi publication, where the link is given in this. The book is priced at 455 rupees, which includes the postage charge. So if you wish to know about the topics that I have told you in the previous slide, you can purchase the book, and I would request you you can give me the feedbacks, what you've liked, what improvement you would like to see in the future, so that I can implement the same. Thanks for watching the presentation, and you can approach me either by writing over my email, or you can WhatsApp me. You can also call me, right? So thanks for listening, and watch for next presentation.